Well, good morning and welcome to the Reserve Bank. With me, I've got John McDermott, who you're all very familiar with, who's the Chief Economist and the Assistant Governor. It's great to have the students here from Kristen School in Auckland. They were the winners of this year's Monetary Policy Challenge amongst 52 schools, so congratulations. It's great to see you here. So let me just summarise the statement. The Reserve Bank today left the official cash rate unchanged at 1.75%. Global economic growth has become more broad-based in recent quarters. However, inflation and wage outcomes remain subdued across the advanced economies, and challenges remain with ongoing surplus capacity. Monetary policy is expected to remain stimulatory in the advanced economies, but less so going forward. The trade-weighted exchange rate has increased since the May statement, partly in response to a weaker US dollar. A lower New Zealand dollar is needed to increase tradables inflation and help deliver more balanced growth. GDP in the March quarter was lower than expected, but is expected to improve going forward, supported by accommodative monetary policy, strong population growth, and elevated terms of trade, and the fiscal stimulus outlined in Budget 2017. The moderation in house prices is expected to persist, although there remains a risk of resurgence in prices given continued strong population growth and resource constraints in the construction sector. Headline inflation is likely to decline in coming quarters as the effect of higher fuel and food prices dissipates. The outlook for tradables inflation remains weak. Non-tradables inflation remains moderate, but is expected to increase gradually as capacity pressures increase, bringing headline inflation to the midpoint of the target range over the medium term. Longer-term inflation expectations remain well anchored at around 2%. Monetary policy will remain accommodative for a considerable period. Numerous uncertainties remain, and policy may need to adjust accordingly. So thanks very much. We're happy to take your questions.
We've been doing a lot of work trying to understand why inflation has been particularly low in New Zealand. And actually, it's also true globally. And it's on some of the avenue of research has not been towards resource utilisation. That seems to be the same. It is more so that inflation expectations have been more important in the inflation dynamics. And particularly people are thinking about what's just happened to inflation more so than what they think will happen in the future. And that's been a strong finding from a number of analytical pieces the bank has put out. And because of that, and because inflation has stayed low, it's had a much more lingering impact on our forecasts. And so that past low inflation is needed to understand why inflation has continued to be very low. And because of that, you need monetary policy to be more stimulatory to compensate for that change of price setting behaviour.
But look, what we've got here is, I think, a number of structural factors globally that are weighing on inflation and have for some time. And it's always going to be a challenge in trying to assess the growth in the economy and the growth potential of the economy, and therefore the output gap that might appear at any time, and to what extent that creates inflation pressures versus the sort of the more structural elements of inflation that are out there, and some of those are very powerful. The risk, I think, is that house price inflation could pick up again. We're clearly not sure about that. We're pleased to see the deceleration that's occurred. But if you look at the strength of the migration flows, which continue to surprise us because we'd been forecasting that they would start to fall away, they're continuing, and also mortgage rates remain low. And we did see house price inflation start to fall quite significantly before the last election, and then it picked up afterwards. So that's always possible. But we are also seeing the banks tighten up pretty significantly in terms of their credit lending decisions. So we're pleased, as I say, to see the house price inflation falling. We're continuing to forecast that it will moderate further, but there is an upside risk.